Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And we are happy to have you along wherever you happen to be. The show now airs in a little over 30 states. So we always talk about Indiana because that's our headquarters. We're located about a half an hour actually, north of Indianapolis, in a town called Anderson. But wherever you happen to be listening, or even if you're on infotainment radio, we certainly appreciate you taking the time out of your day. Don't forget, if you miss something, you can get it on the podcast. Anywhere you listen to podcast, iTunes, or any of the other places, Consider This Program. Today, Angie's got a few things in store for us that are a little bit, they're all driven by you. When you guys email in or call in questions, if you call the office, 800-928-4001, Angie's the one you're going to talk to figure out whether or not you should come in and visit with us, share a cup of coffee. She's also the one that takes your questions and assembles the program. So today, she wanted to talk about HSAs as being used for retirement.
Yes.
Was that a caller, or is that something you were studying? Where'd that one come from?
That actually stemmed from a question of someone wanting to know about withdrawing from their HSA.
Gotcha.
So.
We're going to talk about getting a second job. And though I laughed at her when she first presented that, because most of you that are listening to the show don't really have any desire to get a second quote-unquote job. But the more I thought about it, it actually provided a couple solutions for questions that people had asked. We're going to talk about tax changes and how people are still in the dark. Some of the things that people thought were illegal. The percentages were high enough when quizzed by a Harris poll that some of you may be a little confused as well. So we'll sum that up. And then the other one, and this is a question we get a lot of times, when people are leaving a pension, should they take a lump sum or should they put money into the market slowly? So we will answer those questions for you. Again, if you've got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. If you go to the website, don't forget to get signed up for our weekly economic newsletter. We call it the Market Carver. Myself or Adam Harder, our chief investment strategist, break down what we think were the most important things that occurred last week. With all of the recent volatility in the market, you can bet this video will be watched a lot. Hey, thanks for joining us here on Consider This Program. We will take a break and be right back. Again, it's 800-928-4001.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you two along and the rest of you out there that are listening as well. So, all right, here's the deal. Because I had to kind of put this together in my head as as we started this conversation. I do a lot of work with a group. The driver is a gentleman named Ed Salat. He's considered one of the number one IRA gurus in the nation. He's a CPA, and I'm in his Master Elite program, have been for 12 or 13 years now. I was one of the co-founders. And twice a year, we go hide into rooms to study Ken's favorite topic, IRAs, and read private letter rulings. And bottom line is we've kind of branched out a little bit to add into that 401ks and this wonderful three-letter word called an HSA. So what does HSA stand for, Angie?
I don't know.
Health
Health
savings account.
There you go, Ken.
How about that?
Woohoo! Do you have an HSA, Ken?
We have an option to, whenever we sign up for our benefits last year with Milestone, we did have an option to do a HSA or your regular PPO.
Okay. And you went with the regular.
Correct. Because through the NFL, I actually have kind of a HSA that any type of expense that I cannot, anything I have to pay outside of pocket for my insurance, I get to reimburse through the NFL.
Got it. Fair enough. Makes sense.
It
that
does.
way. So an HSA is a health savings account, as Ken put it, and you have to have a high deductible insurance plan in order to be able to get it. And so the government has a definition of what high deductible plans are. We have an HSA here at the firm. The idea is that you can essentially get a triple tax benefit by putting money into the HSA. So it goes in without Social Security tax. It grows tax deferred, and if used for a qualified medical expense, it comes out tax-free, including the earnings. So it's a bam, bam, bam. It's one of the best things that's out there in that regard. You can put in $7,000 a year if you're a family, like Barb and I are on our HSA. And once we're over 55, I love it how they come up with these arbitrary numbers. Once you're over 55, then we can put in an extra $1,000. So remember, on an IRA, your catch-up provision starts at 50, where you can put in an extra $1,000 a year into your IRA and your 401k. With the HSA, it's 55. So fire off your questions, Angie.
Well, someone had asked if their withdrawals from their HSA had to be used for medical expenses.
They don't have to be used for medical expenses.
Well, what happens if you use them for something else?
Bad things happen if you use them. So here's one of the strategies. You can get, when you have a receipt for anything that is medical, so doctor prescribed vitamins, a doctor visit, a hospital bill, anything that you pay, as Ken said, out of pocket, you can take money out of your HSA free and clear to be able to cover those. So if I found receipts where I had paid for stuff that were 10 years old, in theory, I could take out money and be just fine. Right? Now, what's happening is some people are using the HSAs constantly. Right? They're putting money in and they're taking the money out to cover the healthcare costs because they've got no choice. That's what they need to do. Other people are putting the money in and then not using it at all, waiting until they get to 65. So if you're under age 65, so this rule, Ken, has nothing to do with 59 and a half like an IRA. If you're if you're 65 or over, and you pull money out of your HSA that is not for a qualified medical expense, and that even includes your Medicare premiums, then it's a full taxation just like it was IRA money. So the money grew tax deferred, and you're going to pay taxes on whatever it is you withdraw. Again, if it's a qualified medical expense, you don't even pay the taxes on it. It's a beautiful, beautiful gig. Now, the problem, Angie, is when you pull it out prior to 65.
Yes.
You pull money out of an IRA early, so before 59 and a half, you have a 10% federal penalty. In an HSA, you get a double that number. It's a 20% penalty. And so you really don't want to go in there to use it unless you have to.
Right.
I mean, we all know emergencies come up, but it is available, Ken. So if somebody, in theory, had $10,000 in their HSA and they wanted to pull it out to be able to use to put down on a mortgage, right?
Mm-hmm.
They would have a 20% penalty and then the full taxation on the rest of the
Wow.
money. So not best use of funds, but possible. All right, what else, Ange?
So if you are allowed to contribute $7,000 a year,
Uh-huh.
what if your high deductible insurance covers your whole entire family? Is it still the same contribution that you're
Same
allowed?
contribution.
Okay.
It's like $3,500 if you're an individual. $7,000 if you're a family. So if you've got 5 kids, you're still only putting in $7,000.
Okay. Let me see what other question I had.
One of the questions that we regularly get on HSAs is can you invest the money? And some HSAs say you have to have at least $1,000 inside of them before you can start investing in the funds that are in the plan. Our HSA gets used. Really hadn't thought about letting it grow in the tax deferred setting because I'm not a huge fan of tax deferral for the most part. Right. I look at it as taxes are on sale today. But I get the point, and we will clearly have healthcare cost when I get to 65 or 66 that have to be paid for. So it probably makes sense that we take care of stuff out of pocket today and allow that money to continue to grow. So I was looking at our investment options, and they're not my favorite. I mean, that's one of the reasons we help people roll money out of their 401ks into IRAs when they can, is so you have access to the investment options that we can use at TD Ameritrade, as opposed to what's limited by the chassis or the 401k, or in this case, the HSA.
What happens if you change jobs? Can you roll it into
the HSA? Is really not attached to a job,
okay.
Right? So they're individual accounts, very similar to an IRA. Why people think they're established at work and why they look like they're at work is because your employer has to offer that high deductible plan in order for you to be able to contribute to an HSA. So our HSAs are all at a bank in Lafayette.
Yep.
And that's where Purdue's at for you out-of-state listeners. I was lucky enough to be able to teach there for 7 years, and we've got a big office in Lafayette, Indiana. But we put money into it monthly out of your check, so that you don't have to pay Social Security tax on it. And newsflash, that means I don't, as the employer, have to pay Social Security tax on it either, right? This is why, and you just have to understand whether that's in your best interest or not. I mean, that's why employers will put in AFLAC and insurance policies like that, because you can buy accident insurance and cancer insurance, and if you're not having to pay Social Security tax on it, that means the employer's not either, right? Which in theory could reduce your benefits later on, depending on what your income is.
So what's the biggest benefit of a HSA?
The biggest benefit is that you're able to take care of medical things that are ordered by a doctor without ever paying any taxes on them at all, right? In your PPO, anything that you have out of pocket, the NFL is addressing, right? In my household, that was not the case. So if we had a PPO and I had a $2,000 deductible, that $2,000 was taxed, right? And Social Security on it, and the tax on it, and everything else. Now it's all free and clear if you use the HSA correctly.
Well, I noticed too that you said one of the things is that you have to have a high deductible plan to qualify for this. I also saw that you cannot be enrolled in Medicare, and you can't be a dependent on anyone else's tax return.
That's why it's on the family. That's just how it works. Hey, you're listening to Consider This Program. I'm Joe Clark, along with Ken Dilger, Angie Kinzer. We are here to help you reduce financial regret. That's our love and life. You got a question or comment, give Angie a call, 800-928-4001. We'd love to sit down, have a cup of coffee with you. If you're looking for a fiduciary, that is our job, and we would be happy to talk with you. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Welcome back to Consider This Program. I'm Joe Clark, your host.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you along. Angie, I'm going to let you bring this topic up, but I will tell you, I get questions from people in late stage parts of their career that ask me, how can I possibly get more money into retirement programs?
Yes.
Maybe they're making more money. Something's changed in their life. The kid's college is paid for. They want to keep working, but they want to try to figure out how to get more money into retirement. And I will tell you, with the tax code change in 2017, what you're getting ready to talk about may make more sense now than ever before. So go ahead.
Yeah, a lot of people have talked about, hey, we're almost to retirement, we're in the home stretch, but may just need a little bit more, so may start a job on the side. And so they've asked about, self-employed or having your own little job. So first I thought, what are the differences between some of these IRAs that you can contribute to, like a SEP or a Simple or this Unikay?
So the idea, let's just stick with the SEP because it's the simpler one, right?
Okay.
So what happens is the only person who can contribute to a SEP IRA is your employer. Technically, you don't put any money in. But let's say you've got a business. Well, we'll use me as an example,
Okay.
right? Because it's the easiest way to do that. I broke my company into two parts. So there's the Financial Enhancement Group that where we do our financial planning and help people with money, and then I have another company that produces this radio show that does other things like that. And it's I'm a solopreneur in the other company. It's me, myself, and I. That's actually a legal term for the Department of Labor. So Barb could actually work with me, and we could still be solopreneurs. I can't hire the girls, right? So it could be a husband and wife. I don't even want to go into the other parts, but it could be two married people, but it can't be kids, right? We'll just leave it at that way. So if you put money into a 401k and you're under 50 years old, technically, depending on how it's structured and if the plan allows it, you can put as much as $56,000 a year into the plan. Okay. Now, not all of it can be tax deferred, and I know what some of you are thinking. Well, Joe, I can't put near that in. They won't let me put that at work. They're only letting me put in 18.5 or 25,000 if you are over 50. I get it. Your plan document has to allow for it, and most plan documents don't, because what you do for one, you have to do for another, and it's very, very expensive to put in all of that other matching. So in solo 401ks, we see it a lot where people are able to put in that other $20,000 that they weren't able to put in their first plan. Where SEP comes into play, Angie, is you're now working for another company. So I am an employee, technically, of my other company. Consider this program. I'm an employee. It sends me a W-2 every year. I have to pay Social Security taxes on the money that I make, et cetera, et cetera. I'm a true employee. That's the way that it looks. Now, if my employer, which happens to also be me, right, decided to be nice enough, I could put another $56,000 a year into one of those retirement plans. Again, it all couldn't be tax deferred, but I could essentially double dip. I could put money into two retirement accounts. So when we've got a lot of engineers that we take care of here at the firm, and what we'll find in their later stage careers, some of them will start a consulting company. They think about retiring, but they really don't want to retire. But they want to do some consulting or specialized, or they want to become professors or whatever. And we'll see them open up a small company. My father-in-law did this when he was getting ready to retire from Guide, a General Motors plant here in Anderson. And you just have another company, and all of a sudden you've got this part-time job that you're talking about. Part of that money can come out as Section 199A income if it's structured correctly, which means it's taxed preferentially. And then you can also put money into the retirement plan. So it's a good gig for people where it makes sense.
How does that work if you are self-employed as a sole proprietor, just say reporting on a Schedule C? What if you don't have an employer? You're just your own.
You're still working for that company.
Okay.
And that's, I'm not going to get into the legalese of that, or that's between you and your CPA. I will tell you, in the world that we live in today, very few of you should be doing what's called a DBA, doing business as a sole. The liability is just too great, right? I mean, if you have any assets at all, that are not in a 401k, and in Indiana, IRAs are protected as well from creditor and bankruptcy. But if you've got assets, a house and things like that, you want that's sheltered from any business dealings that you do.
Okay, so how about catch-up contributions? Do they apply to a SEP?
Well, that's where that when you get over 50 years old, you can start to put in more money. Same as inside of a 401k. Don't want to confuse you, but it's in a 401k. It's about a $5,000 differential in terms of what you can put in, and in the SEP would be the same way.
Would contributions have to be consistent? Like, would they have to be every year? Like,
They do not have to be every year, which is an important part of the process. It's not like it's a salary reduction where you have to have money taken out of your check every week. You can get to the end of the year. Actually, if you file an extension correctly, we're in 2019 as the time of this taping. We're in 2019. Technically, you could make a SEP contribution all the way up until October 15th of 2020 for the year 2019. So your CPA has the ability to go in and do the taxes. Now, you want to get the plan set up before the end of the year. You just may not, and you need to be getting on that. There's some dates that you need to be checking into about when the plan has to be established. But I could put money in 19, not have a good year in 2020. Ken, the mortgage business, you're going to be trying to hide money this year with all. If you're listening to this show, if you have a mortgage, seriously, if you have a mortgage, you really need to examine what the interest rate is and call Ken or somebody like that in the mortgage industry, because there is a large probability you need to refinance if you've got much debt out there at all in the mortgage world, because interest rates are just collapsing. This will not last forever, but it is certainly here now. So
okay. How about triggering events? Can those, if you have to take a distribution for whatever triggering event, can those now be rolled into an IRA?
They can. The plan has to be open for a couple of years, but you do have the ability to stop it and roll it into an IRA later in life if you don't need to have both the plans open. What we find is the majority of people either have a SEP that's their main vehicle for retirement that they've been funding every year for a long time and still fund, or they used it as a one-off, like we just talked about a second ago. And when that happens, and the rules allow for it, we will combine it into an IRA. As a general rule, you want as few accounts as you can possibly get. Right? Remember the fiduciary focus. Risk and volatility, fees and expenses, taxes today and tomorrow, and real return. Those are the 4 things on your checklist to make sure that you're taking care of your money as a fiduciary. Because if you haven't hired somebody like me or in the Financial Enhancement Group, you are your own fiduciary. If you've got a broker, you're working at a wirehouse, you're the fiduciary, right? So your job, risk and volatility, fees and expenses, taxes today and tomorrow, real return. Generally, the fewer accounts you have, the lower your fees and expenses will be. Also, the more money you have with an asset manager, it will typically be lower. So, hey, you guys are listening to Consider This program. I hope you're enjoying it. Sorry about the sniffles. The allergy. Something's got me here a little bit today. But I certainly do apologize. You got a question or comment? Give Angie a call, 800-928-4001. If you want to do this on your own, that's your business. If you're looking for a fiduciary, that's our business. Again, 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Welcome to Consider This program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
We're more than honored to have you around, or as I used to say, tickled pink.
Yeah.
Right? I'm not sure I've ever been pink, but, and I really don't appreciate being tickled that much. But
Are you ticklish?
Sometimes. Barb says she's not ticklish at all unless I touch her. And then suddenly it comes out. And nobody else better be tickling her. So
That's
there
true.
you go. There you go. All right, Angie, what are we working on this time?
We are talking about, I'll just come out with the question. Should I invest a lump sum immediately or over time? I don't know if they're talking about an inheritance, won the lottery, whatever it may be, you get a lump sum. So should the investment be, an immediate investment, or is it something you should space out over time?
What do you think, Ken?
That's a good question. I would think a lump sum would have more, return over a 5 or 10 year period.
Bing, 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 bing. Very good answer. So the research that we look at in CFPville, the other terminology, by the way, if you're studying or if you see it written out, you'll see the 3 letters DCA, David Charlie Alpha, and it stands for dollar cost averaging. So when you look at your 401k, you dollar cost average by definition because you're putting money in every month, right?
Mm-hmm.
And there are periods of time in extreme volatility where dollar cost averaging actually is helpful, right? Because you're buying in at the low point, right? People had better returns on their 401k for the year in 2008 that were dollar cost averaging in because the market had gone so far down, right? In 2009, it was exactly the opposite because after March 9th, it was a V going straight up the other direction. So it's about 60% of the time, Angie, where you outperform putting money in a lump sum. And Ken hit the point. You've got to have a longer holding period. We're not looking at this over the course of 12 or 24 months. But the market generally is higher over a 5 to 10 year period of time than it is lower. It's just the way the market has worked with volatile periods of time in between.
Mm-hmm.
So if I put it in all in today and the market's higher 5 years from now, I would have to get awful lucky to be able to buy at a lower point, and that's really tough. We called people in 08 and said, you need to get some of this cash to work that you've got. And it's kind of like, Joe, the world's getting ready to die, right? And, you call people, we had people who were calling in July going, I think I need to put more money in. It's kind of like, it's going to be a little volatile here for a while. And
Yeah.
it's just how our human behavior works.
And when it's a longer term like that, it seems like the discipline has to be there. It's more difficult to stick to a plan.
Yeah. It's always easier to put money in when it's going up in value than it is to put money in when it's going down in value. But that's exactly what you want to do. When you look at life, Barb's favorite store is Kohl's, right? And at Christmas time, she's a predator. I mean, we just might as well call it what it is, right? Because she'll go to Kohl's and she'll find a sweater that she likes, and let's just say it's $60, right? And I've been there with her. And she'll walk around the table and kind of pick it up a couple times and put it down, and she's not going to buy it. I know she's not going to buy it because I know her, right? But she's going to show up 2 weeks later, and all of a sudden we've got our Christmas specials going on, right? And now all of a sudden the $60 sweater is $40. Not only does she buy it, she's going to post on social media that she got it for 50% off. She's going to, or 30% off, whatever the number is. She's going to call her mom and brag, right? I mean, and she's going
to have Kohl's cash
and
to boot.
She's going to have
Right.
Kohl's cash, and she's got a new sweater, and everybody is happy, and she's going to tell me she saved $20, and I'm going to just roll my eyes and go, no, honey, you don't ever save by spending. But the bottom line is you can have the same thing happen with stock, right? You've got a company you identified, you like it, and the stock market goes down, kind of like it is right now the last few days. And, suddenly I don't like that company anymore. I don't want to do that. I don't want to mess with it. And it's just weird mentality. But anyhow, back to your questions, Ange.
Okay, we talk a lot about charitable contributions. So this question is, what if you want to donate some of the proceeds from a lump sum? Would you take possession of the money first and then donate, or what's the best way to donate?
Your first question, where you said you didn't know if they hit the lottery or inherited money, or if they were coming out of a 401k, the first question didn't really matter. Statistically, you're better to do a lump sum than dollar cost average if you're going to put money, if you're going to have an extended holding period, like retirement,
Yes.
30 years, even 10. Now it does matter, right? Because if I'm inheriting money, so Angie dies and she leaves me $1 million. I get what's called a step up in basis in an account that's outside of an IRA, right? So it doesn't matter what you bought the stocks for. You died, I got them, and so there's no reason for me to transfer those stocks to the charity, right? I can write them a check. I can sell the stocks because I'm not going to have to pay any taxes on it.
Mm-hmm.
If you left me an inherited IRA, I can't do anything with that IRA to give it to charity until I'm 70 and a half. And under the current rules, I could use part of your inherited IRA at that point to be a qualified charitable distribution to satisfy the required minimum distribution things. But I've got to be over 70 and a half, and I'm a long way away from there. You know, when you say 20 years, it doesn't sound that long, does it? Angie,
No.
this is not good. Anyhow,
I think kind of what they were talking about in that specific question was the sale of a business lump sum.
So in the sale of a business, you could actually gift part of if you knew the sale was imminent, if the deal was kind of done. And again, this is where you want to work with a qualified professional. You make sure your CPA is involved. But you could take part of your stock. Let's say Ken was going to buy the Financial Enhancement Group. We're not for sale, so don't get excited. But Ken's going to buy the Financial Enhancement Group, and I want part of the money to go to the church, right?
Mm-hmm.
I could actually give the church some of the stock, and then Ken would pay some of the money directly to the church
Okay.
to redeem the stock to get it back.
So when you gift it to them, do they have a step up in basis, or what's their?
No, because there's a gift during life, but they're a church, so there is no issue,
right?
If I gave shares to Angie, and you bought them from Angie, her basis would be my basis.
What about kids?
Same thing. Anytime a gift is done during life, basis remains consistent. And if basis is a new word to you, it simply means what did I pay of after-tax dollars to buy it, right? So, we bought Apple back in 2006. Our basis is about $9 a share. Apple's stock price is about $200 a share today. So anytime I sell those shares, we have to pay about $180, $190 in capital gains tax. If I gave it to Ken during life, which I can do, I can give him $15,000 a year. If I gave Ken the Apple stock, his basis is my basis, and you sell it, you're going to pay long-term capital gains on that $180 or $190. On the other hand, if I give it to the church, they don't pay taxes at all, right? And if I die, you wouldn't pay taxes at all on it from an income tax standpoint because you get a step up in basis. One more question on there.
Well, talking about volatility, here's the question. What if I invest a lump sum and the market immediately falls?
Ouch.
I know.
It happens. And people always, you will always do more to move away from pain than you will from pleasure. Mm-hmm. But the one thing that you have to analyze, and that's why you hire somebody to help you with this, you have to analyze the probability or possibility of what would happen if the market took a sudden drop versus what would happen if the market went straight up.
Yes.
How much pain can you take while the market's going up while you're sitting in cash before you eventually capitulate, which is usually a sign of panic and pulling out. I've been in this business for 31 years. Believe me, people capitulate to put money in, just like they do to pull money out.
Yes.
Hey, you're listening to Consider This Program. I'm Joe Clark, along with Ken Dilger, Angie Kinzer. Happy to answer your questions. You got a comment or anything of that nature, give us a call, 800-928-4001. Do not forget to download the podcast. Consider This Program at iTunes or wherever you listen to podcasts. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This Program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Ken, there are 2 tax codes in the United States.
Really? Why?
Well, I think most people, if you ask them that, would say, yeah, there's 2. There's one for the rich and there's one for the poor, right? I'm here to tell you that it's one for the informed and one for the uninformed. I've seen people with a whole lot of money make some very, very, very silly mistakes. And I've got to brag on some of our CPA partners, E-Step Doctor and Company in Muncie, about a half an hour from our office here in Anderson. Our partners that we work with in the CPA world, got a lot of mutual families that we take care of. And the tax code came out, and this is going to make me sound like a geek, but I am, so it is what it is, right? The tax code came out to us December 17th at 5:30 p.m., so it was a Friday night, and 1,097 pages, and I read it over the weekend, and at 4:30 Monday morning, my CPA, Ben, texts me, and he says, have you seen the CPA journal yet? The digital online CPA journal. And I hadn't. I've been busy reading the tax code. The point being that in the number one CPA document that we get, in our world, in the investment world, we get one from the Financial Planning Association, and we get one from the Chartered Financial Analyst, the CFA. So we get two. Those are the big dogs. That's what you rely on, right? So here it is. This major tax code change has been done. The CPA journal comes out, and it's wrong, right? And it's wrong. And it's wrong because people assumed, because they didn't read the 1,097 pages, people assumed that what people had discussed was going to be in the bill actually made it to the bill. And if you've ever been to Washington, how sausage is made, you really don't want to know. You really don't want to know how bills are passed. I mean, when you hear the bridge to nowhere and all of those other things that are added in at the last minute to get deals done. So a lot of things came out that were wrong, and a firm in Muncie, Indiana had to correct those in Washington, D.C.
Wow.
Kind of smart people around here in
Yes.
Indiana. All right,
Yes.
questions?
Well, an article came out last week that I ran across, and it was talking about the tax changes and how most are still in the dark on what that included and what it means. And it was talking about a Harris Poll survey saying that, most Americans don't know what tax bracket they're in. Many believe they're all taxed at one rate. And so there were all these different things. So I went back and pulled up that poll.
Yeah, that one rate's too much is what they would tell you.
Yes, they would think that. So I just kind of started looking at these statistics and then broke down maybe 3 different things that were in the tax code and thought maybe you could break down and explain to us the changes.
Okay.
And so I did have a question about charitable gifting, and it said, how does the new law discourage charitable gifting?
Well,
know
now
what-
that's not fair. So here's what happened. What the IRS tries to figure out is how to simplify, and I know that sounds like hogwash, but they try to simplify your reporting so that there's less chance for quote unquote mistakes, right? The place where they used to find the most mistakes were when people had 3 and 4 kids on their tax return one year. Suddenly you had to put their social security number in, and we lost a few small cities across the country because suddenly those kids were no longer to be found, right? People would put in dog names. I mean, I've seen some crazy, well, my dog eats, right? I mean, it's crazy justification.
Expensive sometimes.
So so they fixed that, right? So you have to have a social security number for a dependent. And then the next one is what happens when you itemize. And so what they did was gave us more money as a standard deduction as opposed to what we got before. And so if you're under if you're under 65, you're able to deduct, if you're married filing jointly, about $24,000 a year. So the big 3 itemized deductions are mortgage interest, state and property taxes, which are capped at $10,000, and charitable contributions. And the bottom line is, especially in central Indiana, most people don't go over that. And so that leads some to believe that the tax code discourages charitable gifting.
Okay, just because you may not be itemizing anymore.
Correct. You may not get as much of a benefit for it as you once did. But it also means you can go to Goodwill and the Christian Center and give them things and not have to worry about getting a little slip filled out. Right?
True.
I mean, it's good and bad.
Okay, so the standard deduction, that's a biggie that changed.
Yes. And so in the idea when you talk about brackets, remember the best way to think about taxes is to think about stair steps. Right? So we all have some money. So you take your income, your adjusted gross income, if you will, at the bottom of page 1 of your return. And if you're married filing jointly and you're under 65, deduct $24,000 from that. If you are over 65, add $1,300 for you and $1,300 for your spouse if they happen to be as well, so $26,600, right? You deduct that, and that's now your standard deduction. Your first step up to about $19,000 of whatever's left is going to be taxed at 10%. Mm-hmm. And then that next step is a 20% jump to 12%. And that is still very, very, very low, folks. Taxes are on sale. That's going to go to 15% at the end of 25. Unless they can figure out how to get the tax provisions to stay in the code as opposed to sunset, which they're designed to do. And then the next jump is huge. It's almost a doubling. It goes to 22%. So paying attention to that bracket definitely matters.
Okay. And I know you've talked about bracket bumping. In this, they call it bunching. So can you explain?
Yeah,
what that is?
we use a concept that's called bracket bumping, and we use it for a couple different things. The 12% bracket, if I could take everything that I owned, Ken, and be taxed today at 12% on it, I would do it. Right?
I think everybody would, Joe.
No, not everybody. Not everybody would. People will say they will until they actually get handed a bill that says, this is what you owe the IRS now, today. Really? Today? I got. You'd be amazed. But at 12%, I'm in, right? All day long. You got to take advantage of that every time that you can. And as I was saying, if you make about $104,000 in terms of all of your income, you're going to be right at the top of the 12% bracket. And $104,000 doesn't sound like a lot of money to you listening in California or on the East Coast. In Central Indiana, you can get by. A husband and wife that have their house paid for can do very well on $104,000 a year. And so let's say you only have $80,000. But you've got $1 million in your IRA. All right. What we're going to help you do is take out every dollar out of your IRA that we can at that 12% bracket and roll it into a Roth IRA. That's one part of the bracket bumping. The second part is, let's say that you're just underneath the standard deduction. And, you've got your standard deduction's $24,000, but because of your charitable gifts, you're at $22,000. And your charitable gifts may be a large part of it. So what we'll have people do is to pay their property taxes twice in 1 year, and their charitable contributions for the upcoming year in this year. So now you've got, instead of having $22,000 worth of itemized deductions, you may have $40,000 worth of itemized deductions. Then the next year you don't give any money to church or your charity, and you take the standard deduction, and you're able to maximize your tax opportunities by doing that. Right?
Okay.
2 tax codes in the United States. Angie, who are they?
One for the informed and one for the uninformed.
And we want you to be informed. Hopefully you do too. That's why you're listening to the show. If you want to know more about us at the Financial Enhancement Group, you can go to our website at yourlifeafterwork.com. But make it easy. Just call Angie, 800-928-4001. We will take a break and get right back. Do not forget to download the podcast. Consider this program. Appreciate all of your wonderful notes of encouragement.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Welcome to Consider This program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And we are happy to have you along. So those of you who don't know, I've got a lot of bosses in my life. Angie's one of them, and she kind of runs the show now. So she said, we're going to keep going on the last tax topic. So
Yes, we
if
didn't-
you happen to have missed that, don't forget you can always get them at our website at yourlifeafterwork.com, or go to get our podcast, Consider This Program. You do have to put in program, but you can download that right off of iTunes. Angie and I interview other professional writers and speakers from time to time. You can't hear them on the radio, but you do get them on the podcast. So there's a kind of an added benefit for that. So keep
Yes.
going.
Okay, so we just talked about the changes in charitable gifting and maybe with the standard deduction. What we didn't talk about was the changes with exemptions. And maybe the changes like to the child tax credit, dependent age children, or homeowner deductions. Are there any changes in mortgages or home equity loans, anything like that?
The only real thing is the home equity line of credits. You cannot deduct those if it's for debt consolidation, correct?
If it's for anything other than improving the property.
Correct.
All right. So you've got a waiver if you had a home equity line of credit balance before the end of 2018. Anything that was taken on to consolidate debt or to do any of that other stuff that wasn't about that actual property is no longer deductible. But there is another one, and you would know this better than I can, but used to you could deduct interest up to $1 million.
Okay.
Right? That has been lowered to $750,000. So those are the two biggies in mortgage interest. But again, some people would argue because of the change to the standard deduction that the mortgage interest isn't an issue because so many people take the standard deduction now. You know, we have families with, more than $2 million in accounts that take the standard deduction now. Because our property taxes aren't that expensive in Indiana, right? And they're limited to $10,000. Just is what it is.
So when we were talking about the bracket bumping or bunching in the previous segment, we're mentioning charitable gifting. What about mortgage interest?
Well, that is the deduction. So,
Okay.
so on your if you itemize,
Yes.
you can deduct mortgage interest,
Right.
provided it was used for the property. So there's two different types of mortgages that people would get, right? And you were in the mortgage industry years and years ago before you got here, right? So people would get home equity lines of credit and then pay off higher interest rate stuff, typically credit cards, those kind of things. Made Ken happy because suddenly your monthly payment was lowered, that the income ratio looked like it had improved. We played some hocus pocus, and all of a sudden people could get a mortgage. It's just
So during the application process, Ken, do they ask more questions then about what you're going to do with that home equity loan?
It depends on what they're trying to do. Most people when they buy a house usually don't take out a home equity line of credit.
Right.
If they do, it's to get rid of PMI. But 2 or 3 years later, if they do put down, let's say 20% and say, hey, we want to fix up this, they have equity in their house to do a HELOC, we call it.
Okay.
So
I just didn't know how they would know what you're using it for. I mean, when do they ask that question?
well, the they is not the mortgage person.
No,
So that's where that's
no.
always got.
That's what I wondered, though, if
and
there were any documents
you're-
when you took the loan
you're-
out.
Whoever's doing your tax return, remember where it's a self-reporting organization
Okay.
for the IRS. CPAs have taken upon themselves to be tax collectors. That's they are supposed to ask those questions. I will tell you, some do and some do not. Just in my experience, but it's anyhow. That's
Okay.
yeah.
Well, I noticed on here too, and I don't know really anything about this. This will have to be all on you, but changes to the child tax credit, it said it doubled to $2,000 per child.
Yeah, it was.
I-
Those are benefits that we rarely see.
Okay.
You go through 3 phases of finance in your life, my friends. There's the first one is accumulation. That's when you're starting to save, building that tax diversification, paying attention to saving the right percentage of your income. It's typically when people have kids. And so I've got planners that deal with people that are in the accumulation phase. That's their strong suit. It's not mine. Preservation and distribution are what I deal with. And preservation is when you're putting money in, but what you're putting in is nothing compared to what you've already saved. Distribution is now that you got it in, how are you going to get it out?
Right.
And we help people design their distribution because, what goes in must come out. And you're either going to let it come out at the force of the hands of the IRS, die and leave it to your heirs to figure out, or we're going to help you do it on your terms and in the best possible tax scenario that we can. All right. So that's what we call designed distribution. So in the podcast or in the radio show today or podcast, wherever you're listening to it, we covered 4 areas. This tax code changes we just summed up. So if you missed that, go back in and listen to that conversation. We talked about the benefits of getting a second job. Ken, are you inspired to get a second job?
Me? No. I got enough jobs at home.
Angie?
I am.
Are you?
I am because I'm a lot older than Ken, and so I don't have as much saved as I would like to as far as a nest egg goes. So if there was something I could do to help build that before my retirement time comes, sure.
So there's 2 reasons why I like the second job theory.
Okay.
The first one is you're able to save more into retirement accounts if it's structured correctly and that's what you want to
Yes.
do. You're looking at it to have more income to be able to do other things for some people, right? They simply need more money right now to either reduce debt or do whatever, right?
Well, I mean, even if I could work a second job and put it all away for my retirement,
There you go.
I would do it.
So here's the other reason why where the second job comes into play. Remember, when you go to retire, your job is to replace 100% of your standard of living, right? So if you have a second job, Ken, and 100% of it's going to retirement, and none of it's going into buying boats, faster cars, and making you feel better, right? Then that's purely not impacting your standard of living. It's just putting more money into retirement, or you're using it to pay off debt. That's a beautiful gig, right? We also talked about the HSA, the health savings account. If you're eligible for that, you ought to consider it. It is a triple tax benefit if used correctly. You don't pay Social Security tax on the money going in. When the money comes out, if it's for a qualified medical benefit, it is tax-free as well as all of the growth. So wham, bam, I like it. However, if you use the money for anything that is not a qualified medical expense, you can expect a 20% penalty, Ken, and that hurts. 20 yards, right? That's the way I used to think about things in college days. Is how many yards do I have to run if this doesn't work out the way that I want, right? Do not talk to me about ladders. And we talked about lump sum. If you retire and you have the opportunity to get a bunch of money at one time, should you invest it all at one time, or should you kind of slowly put it into the market? We talked about dollar cost averaging, its attributes and its failures. Statistically, you are better off to invest the lump sum as long as your holding period is long enough. Any further thoughts there, Angie?
No, I was surprised when I read that. It said 80% of the time the lump sum is
I think it's
going to
closer to
outrun
60, but we'll let them say 80.
it. Okay.
All right. Hey, you're listening to Consider This Program. I'm Joe Clark, along with Angie Kinzer. If you got a question or comment, you can call and ask for Ken. He'll answer the phone. No, he won't, but Angie will. 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
We are having fun. Hope you are too and enjoying the show. So, about this lump sum, Angie, because we can all dream, right?
Yes.
So you've been here at the Financial Enhancement Group for 7 years, I think we decided.
Yep.
Seems like forever.
I think we're at 7.5 now because my anniversary is in April. So that'll be 8 years.
We're at 7.5,
Yes.
somewhere like that. And Ken, you've had the opportunity to take a large payout at one time.
A couple,
right?
yes.
So when that happened, did you take the money and invest it all at one time, or did you invest it slowly?
I'm sure we invested slowly.
I think most people do. It's hard.
Mm-hmm.
It's hard when you don't. It's even though you know the math, right? It is hard. You know, the math says invest it as long as your holding period is long enough. The math says invest it quickly, right? Get it in, and get it over with. In my experience, it is very hard for people to do that, right? It is mathematically the correct answer. But here's the thing that people miss, right? So in, I think it was 96, could have been 97, we had the Asian flu, and a group of very smart investors almost bankrupted the East Coast of the United States. Alan Greenspan had just said the irrational exuberance had taken over the market. And kind of like today, you know, people want to find everything they can to figure out what's wrong, right? And so people went to cash. And they stayed in cash in 97 and 98 and 99. And they were almost cheering for Y2K to be something major. I mean, I knew some of these people, and they were so adamant, Ken, that they just wanted to, you know, because they're watching their neighbors buy new cars every 6 months. I mean, literally, it was happening. You know, we were up way over 100% in 3 years, and you know, people were just doing silly things. And you know, Y2K, the biggest non-event ever, right? It didn't happen, and people showed up. There were several of them showed up in January that had been in cash for 3 years, that capitulated into the market. Up to that period of time, February of 2000 was the largest inflow of money into the market that we had ever seen. And in case you missed it, the peak was March 10th, just, you know, a short 4 or 5 weeks later, right? So it's easy to know the right thing. Sometimes it's harder to do the right thing.
Yes.
So, Angie, if you got the lump sum, what are we going to do?
I'll probably invest it slowly over time. Actually, our chief investment strategist, he was there when I got Adam Harder was reading the article, and I said, "Oh, it looks like it says every time that's going to win." And he said, "Mathematically, yes." And we even call him his nickname, "Man with Math in Head." That's his nickname here. But he said that mathematically, yes, that's what you're going to do. Is that what I'm going to do? I don't know. He said, "I don't know."
Yeah, not that I ever forecast any of that to happen in my life, but it would be I would have to be certain on my holding period being long enough. I would just have to put it that way. Hope you guys enjoyed the show today. Consider this program as the podcast. Don't forget to download it and subscribe if you would, please. We have lots of other things that are on there for you. Remember, if you want to do this on your own, that's your business. If you're looking for a fiduciary, that's our business. Give us a call, 800-928-4001. Have a great week.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800-928-4001